In the early 1980s, two friends in Chicago, Richard Dennis and William Eckhart, found themselves in a heated debate. Dennis, a legendary commodities trader, had turned a small $400 stake into more than $200 million in less than a decade. He believed trading success was mostly a matter of learning and discipline. Eckhart, a mathematician, disagreed. He argued that great traders were born with a certain instinct that couldn't be taught. To settle the argument, Dennis proposed a bold experiment. He would recruit a group of complete strangers, teach them his trading rules in just 2 weeks, and see if they could make money. If they succeeded, it would prove that trading could indeed be taught. The recruitment process was unusual. Dennis placed ads in major newspapers asking for applicants with no prior trading experience. The only requirements were intelligence, discipline, and the willingness to follow instructions. From thousands of applications, 23 men and women were chosen, and they came from all walks of life: an actor, a security guard, a professional blackjack player, and even a few who had never seen a trading floor before. Dennis called them turtles, inspired by a visit to a turtle farm in Singapore. He had seen how turtles could be bred in a controlled environment and believed traders could be grown in the same way if given the right environment and rules. The training was short but intense. Over 2 weeks, Dennis revealed his complete trend-following system: buying breakouts, letting winners run, cutting losers quickly, and managing risk through strict position sizing. The rules were mechanical, leaving little room for personal judgment or emotion. This was a key point. Success came from following the system, not predicting the market. Once trained, the turtles were each given a trading account funded by Dennis, typically between $500,000 and $2 million, and the results were stunning. In just 4 years, the group collectively earned over $100 million in profits. Some individuals more than doubled their capital in a single year. The experiment not only settled the debate, it became one of the most famous stories in trading history. The turtle strategy's origin teaches a crucial lesson. Trading is less about secret market insights and more about having a proven set of rules, the discipline to follow them, and the patience to let probabilities work in your favor. While the original experiment ended in the late 1980s, the principles Dennis taught remain timeless. Even in today's markets, the same ideas, trend following, risk control, and emotion-free execution, continue to form the backbone of many successful trading systems. The true strength of the turtle strategy came from its clear mechanical rules. Unlike many traders who improvise, the turtles had a step-by-step playbook that removed emotions from the decision-making process. These rules covered every aspect of trading: when to enter, when to exit, how much to risk, and how to grow positions. For example, imagine gold has not traded above $2,500 per ounce in the last 20 days. If it suddenly pushes to $2,510, that's a buy signal. The idea isn't to predict why gold is rising, it's to follow the move once momentum has already begun. Every position had a built-in escape plan. The turtles didn't rely on hope or gut instinct. If the market reversed, they would exit on a 10-day low for long trades or a 10-day high for short trades. This kept losses small. For instance, if the S&P 500 broke out above 5,000 and a turtle bought, they would stay in the trade as long as the index stayed above its 10-day low. If the index dipped below that level, they'd exit. No questions asked. And one of Dennis's most powerful lessons was that risk must be adjusted to market volatility. The turtles used the N value, a measure of the average true range, ATR, to calculate position size. The rule was simple: never risk more than 1/2% of the account on a single trade. So if crude oil was moving $2 per day on average and a turtle wanted to risk $1,000 per trade, they would buy enough contracts so that a $2 move against them would equal that $1,000. This kept risk consistent no matter the market. Instead of entering with their full position at once, the turtles added gradually as the market moved in their favor. This is called pyramiding. Each new unit was added at intervals of 0.5N to 1N of favorable price movement. For example, if the euro dollar currency pair broke out and moved steadily upward, a turtle might start with one contract, then add another when the price rose further, and so on. This way, they built large positions only when they were already winning. Dennis insisted that the turtles spread their trades across multiple markets: currencies, commodities, bonds, and stock indexes. This prevented them from betting too heavily on one area. If soybeans were trending but gold was not, they could still catch profits from whichever market was moving. In practice, these rules made the turtle strategy both powerful and simple. There was no guesswork about what to do. If the signal appeared, they acted. If the stop was hit, they exited. If the trade grew, they pyramided. The consistency of applying these rules was what separated the turtles from average traders. The message is clear: your rules are your edge. Without rules, trading becomes gambling. With them, it becomes a repeatable process that can be executed with discipline. If the turtle strategy had a secret weapon, it wasn't the breakout rules, it was risk management. Richard Dennis taught that even a perfect entry system would fail without strict money control. In fact, he often said, "The magic is not in the entries, but in the risk sizing." The turtles were trained to think less about being right and more about staying alive long enough to catch the big trends. This meant protecting capital through calculated risk and smart allocation. The turtles never risked more than 1 to 2% of their account on a single trade, and this prevented one bad trade from destroying their capital. Imagine a turtle has a $100,000 account. If they risk 2%, their maximum loss per trade is $2,000. If they lose 10 trades in a row, they still have $80,000 left, enough to keep trading until the next big trend arrives. Instead of trading the same number of contracts each time, the turtles sized positions based on volatility. They used a formula called N, which measured the average daily price movement. If a market was volatile, like crude oil, they traded fewer contracts. If a market was calm, like bonds, they traded more. This balanced their risk across markets. For instance, one contract of gold and one contract of soybeans might look equal, but gold could swing $30 per day, while soybeans moved only $5. By using volatility-adjusted sizing, both trades carried the same risk. The turtles didn't throw all their money into a position at once. Instead, they built positions step by step as trends confirmed themselves. They would add a new unit every 0.5 N or 1 N of favorable movement, up to a maximum of 4 units. This allowed them to ride trends aggressively, while only committing more capital once the market was moving in their favor. Example: if the euro dollar broke out and climbed steadily, a turtle might buy one contract at the breakout, add another after the price rose further, and keep stacking until the maximum was reached. If the trade failed early, losses were small. If it worked, profits compounded quickly. Dennis insisted that the turtles avoid concentrating all risk in one place. They traded across currencies, commodities, metals, stock indexes, and bonds. This way, even if one market chopped sideways, others might trend. For instance, if wheat, soybeans, and corn were all trending, a turtle wouldn't load up on all three since they were correlated, all grains. Instead, they'd spread exposure across unrelated markets like wheat, crude oil, and Japanese yen. Every trading system has losing streaks. The turtles accepted this as part of the game. They were trained to reduce position sizes during deep drawdowns to protect capital. For example, if a turtle was down 10-15%, they would scale back trade size until performance recovered. This acted like a safety brake to prevent emotional blowups. In the end, money management turned the turtle strategy into more than just a trend-following system. It made it a complete survival plan for trading. Entries and exits decided when to get in and out, but risk management decided whether you'd still be around for the next big trend. That's why many traders who tried to copy the turtle strategy without understanding risk sizing failed. The rules only worked if combined with discipline, patience, and the courage to bet big on winners, while never letting losers get out of hand. The turtle strategy wasn't built on hunches or lucky guesses. Richard Dennis and William Eckhart had already tested their rules on historical market data before teaching them. They understood that trading without proof is gambling, while trading with tested rules is, strategy. Backtesting is the process of applying a trading system to past market data to see how it would have performed. For the turtles, this confirmed that their simple rules, trend following breakouts, volatility based sizing, and strict exits, worked across decades of data and multiple markets. Backtesting gave the turtles two key advantages: confidence in the system. When losses came, they trusted the rules because history showed long term profits. Statistical expectations. They knew the system would win about 40–50% of the time, with most gains coming from a handful of big trends. Example: if crude oil trended strongly 3 times in a year, those trades could pay for dozens of small losing trades in other markets. The core breakout rules were applied to past market prices. 20-day breakout, many trades, faster signals, lower win rate, but quicker to catch moves. The 55-day breakout, fewer trades, higher win rate, slower to enter, but captured big moves. They also tested exit rules, 10-day or 20-day reversals, and confirmed that small losses plus big winners requires net profit. Markets today are faster, influenced by algorithms and global events, but the principles still work. Trends form and traders can ride them. Modern backtesting is easier thanks to trading software. But the same cautions apply. Test across different asset classes: stocks, forex, commodities, crypto. Use decades of data, not just recent years. Include transaction costs, slippage, and commissions. For example, a trader might test the turtle strategy on Bitcoin since 2015. The system would have caught major bull runs 2017, 2020, 2021, while losing small amounts during sideways periods. A common mistake in backtesting is over-optimizing. This happens when traders tweak the system too much to fit past data, making it look perfect in hindsight, but useless in the future. The turtles avoided this trap by keeping rules simple and universal. They didn't change breakout lengths from 20 or 55 days just because 23 or 52 worked better in the past. Dennis knew that markets change, but human behavior, fear, and greed stays the same. The ultimate test isn't history, it's live trading. That's why Dennis gave the turtles real money after their training. Their performance in actual markets proved the system worked. Modern traders can use walk-forward testing, apply the strategy on unseen future data after backtesting to ensure it performs well in real time. Lesson of backtesting. The turtle experiment showed that a strategy doesn't need complexity to work. What matters is that it's tested, consistent, and robust across markets. Backtesting gave the turtles faith to stick with the rules even during losing streaks. The truth is, the hardest part wasn't finding a winning system. It was following it, without hesitation. For example, if crude oil trended strongly 3 times in a year, those trades could pay for dozens of small losing trades in other markets. 20-day breakout, many trades, faster signals, lower win rate, but quicker to catch moves. 55-day breakout, fewer trades, higher win rate, slower to enter, but captured big moves. They also tested exit rules, 10-day or 20-day reversals, and confirmed that small losses and big winners results net profit. Markets today are faster, influenced by algorithms and global events. But the principles still work, trends form, and traders can ride them. Modern backtesting is easier thanks to trading software, but the same cautions apply. Test across different asset classes: stocks, forex, commodities, crypto. Use decades of data, not just recent years. Include transaction costs, slippage, and commissions. For example, a trader might test the turtle strategy on Bitcoin since 2015. The system would have caught major bull runs while losing small amounts during sideways periods. A common mistake in backtesting is over-optimizing. This happens when traders tweak the system too much to fit past data, making it look perfect in hindsight, but useless in the future. The turtles avoided this trap by keeping rules simple and universal. They didn't change breakout lengths from 20 or 55 days just because 23 or 52 worked better in the past. Dennis knew that markets change, but human behavior, fear, and greed stays the same. The ultimate test isn't history, it's live trading. That's why Dennis gave the turtles real money after their training. Their performance in actual markets proved the system worked. Modern traders can use walk forward testing. Apply the strategy on unseen future data after backtesting to ensure it performs well in real time. The turtle experiment showed that a strategy doesn't need complexity to work. What matters is that it's tested, consistent, and robust across markets. Backtesting gave the turtles faith to stick with the rules even during losing streaks. The truth is, the hardest part wasn't finding a winning system, it was following it without hesitation. The turtle strategy gave traders a clear set of rules, but following them was far from easy. In fact, many of the original turtles admitted that the biggest challenge wasn't the markets, it was themselves. Richard Dennis often said, I always say you could publish my trading rules in the newspaper and no one would follow them. The key is consistency and discipline. That statement reveals the heart of the problem. Knowing the rules is one thing, but sticking to them through fear, greed, and doubt is another. One of the most common pitfalls is trading too often, jumping into positions without a valid signal. New traders get impatient and try to force opportunities. The turtles were told to wait, sometimes for weeks, until a breakout appeared. But waiting is hard. Many failed because they couldn't resist chasing trades that didn't fit the system. Human psychology pushes us to take quick profits. When a trade goes up a little, many traders close it out, fearing the gain will vanish. But the turtle strategy works because of big winners, the rare trades that run for weeks or months. Example, a turtle might have entered crude oil at $40 and watched it climb to $80. Without discipline, a trader might sell at 50 or 55, missing the real payoff. The opposite mistake is refusing to exit when trades go wrong. Losses hurt, and people often hope the market will come back. The turtles were trained to cut losses immediately, no matter how painful. Small losses are the price of survival. Trading triggers strong emotions. After a string of losses, fear creeps in. What if the system doesn't work anymore? After a string of wins, greed takes over. Maybe I should double my size. Both emotions lead to breaking the rules. The turtles learned that discipline meant acting like a machine. Follow the system, not the feelings. Every trading system goes through losing streaks, sometimes lasting months. The turtles faced periods where every breakout failed. Many beginners would have quit, but the experienced turtles trusted the statistics. They knew a big trend was always around the corner. Dennis taught them, you don't need to win often. You just need to win big when the market lets you. Ultimately, the turtle experiment wasn't just about trading. It was about psychology. The rules were simple, but mastering the patience, courage, and humility to follow them was what created millionaires out of ordinary people. The lesson for modern traders is timeless. Discipline beats prediction. Markets are unpredictable, but your actions don't have to be. By avoiding emotional traps, sticking to tested rules, and managing risk, anyone can trade like a turtle. The story of the turtles proves that success in trading isn't about secret indicators or insider knowledge. It's about consistency, self-control, and the ability to think long-term while everyone else reacts short-term. In the end, the greatest battle wasn't against the market. It was against human nature.